Hey everyone, this is the sixth lesson on financial accounting. In the last lesson, we went over the third and final level of the conceptual framework. So in this lesson, we're going to be talking about the accounting equation and debits and credits. First, though, we have to define a few terms that we're going to be using throughout the lesson and also throughout the course. So the first term I want to go over is account. So basically, accounts are what make up the financial statements. If you remember from the elements of financial statements from the second level of the conceptual framework, three key elements were assets, liabilities, and equity. So some accounts in each of those categories would be assets comprising of cash, accounts receivable, inventory, investments, etc. The next terms I want to go over are real and nominal accounts. Real accounts are permanent, while nominal accounts are temporary. Real accounts are stated on the balance sheet, while nominal accounts are typically shown on the income statement. So in the previous example I used, some permanent accounts or real accounts would be cash, investments, inventory, property, plant and equipment, etc. Some temporary accounts would be revenue and expenses because they're eventually closed at the end of the year to a permanent account. So the next term I want to go over is ledger. So a ledger is basically a book containing all of the accounts, and this is usually a digital version because most companies use accounting software as opposed to a paper-based accounting system. So there are basically a few different types of ledgers. The first is the general ledger, which contains all accounts. So the general ledger contains all of the accounts, regardless of whether they are balance sheet accounts or income statement accounts or whatever. As opposed to that, we have subsidiary ledger, which contains details for specific accounts. An example of that would be the accounts receivable subsidiary ledger. It's going to be basically a list of all the different customer accounts that owe us money, and the sum of all those accounts is going to be what is reported on the balance sheet as the total accounts receivable amount. The next term I want to go over is journal. The journal is basically a book where we record transactions. Transactions are first journalized, they're recorded in the journal, and then they're transferred to the ledger. So what's important to note right now is that first we record transactions in the journal, and then afterwards we transfer those amounts and the general ledger. So the next term I want to go over is posting. I mentioned that we transfer amounts from the journal to the ledger. That process is called posting. So let me give you an example. If we record a transaction in the journal, the account balances won't reflect that transaction until we post the journal entries. So the next term I want to go over is trial balance. The trial balance is basically a gigantic list of all the open accounts and their balances. Trial balances can be prepared pretty much at any time throughout the year, and there are different types of trial balances. After you make adjusting entries, which we're going to talk about in just a minute, you can prepare an adjusted trial balance. But it's important to know that they can be prepared at pretty much any time. So I mentioned adjusting entries. These are entries made at the end of the accounting period to make all accounts up to date. I'm going to be going over that in greater detail in future videos, but basically all you need to know now is that you don't have to worry about these entries until the end of the accounting period. So the next term is financial statements. Now I've been mentioning this throughout my other videos time and time again, but I haven't really gone into detail into what I actually mean by this term. So there are basically 4 different types of financial statements. First is the balance sheet. Balance sheet is going to be showing the financial condition of a company. And the balance sheet can be prepared at any date throughout the year. It isn't necessarily only prepared at the end of the period, and so it's called a snapshot, because it gives you the financial condition of a company at any certain point in time. Now, on the other hand, the income statement measures results of operation. Now this would be referred to sort of as a video, because it's going to be showing change over time. And in this case, we're going to be showing change in revenue accounts, change in expense accounts, and all the different types of gains and losses that we occur over a certain period of time. Alright, so the third financial statement is the statement of cash flows. Now this shows changes in cash and the activities that influence that change. Now this can also be thought of as a video because it shows change over time as opposed to just a snapshot of the company at a certain date. Now the last financial statement is the statement of retained earnings. This is basically going to reconcile the beginning balance of retained earnings at the end of the period. Now again, this is a video because it shows change over time. We basically take the beginning balance for retained earnings and show all the activities that affect it, and then we eventually come to the ending balance, which we report in the balance sheet. So the last term I want to go over is closing entries. These are entries that we make at the end of the accounting period when we want to close all the nominal accounts, all the temporary accounts, and transfer all the net income or loss to retained earnings. Okay, so now that we have defined all those terms, let's go ahead and talk about the accounting equation. So accounting uses a double entry system, and what that means is that at least two accounts are affected by each transaction. So the accounting equation is very, very important, and this equation must hold true at all points in time. It's not a very complicated equation at all, so you'll have no problem in remembering it, but you'll be using it throughout your entire studies of accounting. Accounting equation is as follows. Assets equal liabilities plus stockholders' equity. Now this equation is illustrated on the balance sheet, and like I said, it must be in balance at all times. If it's not, then there's something wrong with the way you've posted a transaction or the way you've recorded a transaction, and you need to look back and correct those before you can issue your financial statements. So a topic that's very closely related would be debits and credits. So for accounting, you have to forget all the preconceived notions you have of debits and credits, because in accounting, debits and credits mean only left and right. Debits mean left and credits mean right, and that's the only meaning that they have in accounting. So this goes back to the double entry system of accounting. Certain accounts increase with a debit and certain accounts increase with a credit. Now what we have here is a T account. T accounts are used to basically show all the transactions that affect a certain account, and we eventually come to an ending balance. So assets are increased with the debit balance, with the debit, which is the left side, and they are decreased by a credit. Likewise, expenses are increased by a debit, and they are decreased by a credit. Now, on the other hand, liability accounts increase with a credit and decrease with a debit. And the same holds true for stockholders' equity accounts and revenue accounts. Increase with the credit and decrease with the debit. Now, account balances might change after transactions, but the equation should still hold true, that assets equals liabilities plus equity. In order to further illustrate this, I'm going to go ahead and go over a few sample transactions, and we're going to see how those transactions affect the accounting equation itself. Okay, so the first transaction is owners invest $40,000 in exchange for common stock. So we're going to be dealing with cash, which is an asset, and common stock, which is an equity account. So assets increased by $40,000 and equity also increases by $40,000. Because there weren't really any transaction before this one, it was 0 equals 0 plus 0. And now we have 40,000 equals 0 plus 40,000. The equation still holds true. The second transaction is we disperse $600 cash for secretary wages. Now we're dealing with cash and an expense account, which would be wage expense. Cash decreases by $600 and equity also decreases by $600. Now, as you can see, again, the equation is still intact. Third transaction would be purchasing office equipment priced at $5,200, giving a 10-year promissory note in exchange. So we're going to be increasing our balance for equipment by $5,200 and increasing our balance of notes payable for $5,200 as well. The fourth transaction is receiving $4,000 in exchange for services rendered. So basically we have $4,000 of revenue by providing service. Again, cash is increased by $4,000 and equity is increased by $4,000 with the increase of revenue. Fifth transaction is that we pay off a short-term liability of $7,000. So obviously liabilities are going to decrease by $7,000 and we're going to be paying $7,000 of cash, so assets decrease by $7,000. Now the sixth transaction is declaring a cash dividend of $5,000. So again, assets are going to decrease by $5,000 and equity is going to decrease by $5,000. Seventh transaction is converting a long-term liability of $80,000 into common stock. Basically relieving ourselves of the liability and adding it to the equity side. So this is an important part. We don't necessarily have to have an asset and either a liability or equity account. We can have two accounts that are on the same side of the equal sign, and the equation should still hold true. Because after this transaction, assets haven't changed at all, and the negative 80,000 and the positive 80,000 come out to zero, and this right side of the equation is really not affected at all. So in our final transaction, we pay $16,000 for a delivery van. So we pay $16,000 in cash. So assets decreased by $16,000, but assets also increased by $16,000 because that's the price we paid for the delivery van. So again, like we had in the previous transaction, both of the accounts that are affected are on one side of the accounting equation. In this example, it's assets, and that side isn't really affected, and because of that, the accounting equation still holds true. Now, if you were to add up all of these numbers, the accounting equation would still hold true. Now, this is very important. This equation has to be intact at all points in time. And if you have any comments, if you have any questions, be sure to leave a comment. Be sure to share with anyone else who you think this might help. Be sure to subscribe if you want to keep up with all these lessons. And until next time, take it easy, guys.